Big story at the bottom there. The 10-year note yield falls to 467. We're talking about a 3-week low for that. So we've got some relief in the Russell, Josh. Small caps are surging. NASDAQ's ripping. Best week there since January. So the best week of the year for the NASDAQ. Why are we going? I said we're 2 for 2, right? Treasury refunding. Check. Powell wasn't hawkish.
Yeah.
Check. That's where we are.
I think there's some mechanics involved here as well. I was talking about this a week ago or 2 weeks ago. There's a phenomenon in the markets, and although it's well known, it's still pretty reliable, which is that mutual funds end their fiscal year on October 31st. You will see enormous selling pressure in the stocks that are already down 10% on the year. You will see those downtrends become exacerbated as funds race to lock in those capital losses. The reason why that's relevant is when the calendar turns over into November 1st, all of a sudden, a lot of that mechanical, artificial selling pressure comes off. And in fact, just like an eyeball test, go look at your portfolio right now, log into Schwab or whatever, and what you'll find is over the last couple of days, a really nice bounce or pop or whatever you want to call it off of the lows for probably anything with a sub $10 billion market cap, anything that's been red all year and losing you money. That phenomenon is helping the Russell 2000. That gives you better internals, makes people feel better. Combine that with the strength that we've seen in tech off of some pretty good earnings. And that's the tone of the tape right now. And what's cool about what I'm talking about, it's not a 1 or 2 day phenomenon. In fact, TLCs, otherwise known as tax loss candidates, actually tend to outperform the market from the whole period, November, December through January. Again, a lot of selling pressure comes off, and what's left? People looking through the rubble and saying, these stocks, this has been overdone. The whole Russell 2000 has been overdone. So I think there's going to be a lot of opportunities in that arena.
Kari, how long does this last, do you think? I mean, the Russell's up, to Josh's point, near 2%, and it's been crushed lately.
Yeah.
But how long does this last?
All right, so the market's up about 4% from the bottom here. The market fell off 11%. Can it get back that whole 11%, which means it has to go up 12 to 13%? And that's asking a lot, but I think certainly that the market can keep going higher. We know that inflation has continued to come down, and we expect that the number is going to be reasonably good, the next CPI number. Good meaning coming down a little bit further. We're not in a recession. There was so much chatter about recession. And we're not there. 4.9% was the GDP number. And we also know that this war in the Middle East, which people last week were very scared was going to escalate to other countries, that hasn't happened yet. So you add up a few of these positives in addition to the bounce, the technical bounce, and I'd say that we can get the S&P 500 to go up another 5%, certainly.
I mean, it was like 10 minutes ago, we were like, okay, S&P's approaching 4,100. It's like 4,105.
Yeah. Moment of truth.
Whoa,
and then here we are at 4,300.
Yeah.
See how that happens?
To your point. So are we saying, are you guys suggesting, Kari, that, because the recession's not here, and we still may have one, and
maybe.
It may come in 24, that the runway is okay for stocks, even if we think a recession is going to happen, just not any time in the next few months?
Yeah, well, here's the way investors could think about it right now. Instead of 3 weeks ago saying to themselves, wow, I can get 5% sort of risk-free, and that's very, very comfortable with the market collapsing the way it was in September and October. Now they're saying, I can only get 5%. 5% is my ceiling, and if I want more than 5%, with most of the market, the S&P 500 unweighted down 2% this year, you can do better than 5% if you take some risk and buy a handful of stocks, a basket, or the index.